So in today's video, I'm going to talk about the ETF called ZWC. Basically, it is the BMO Covered Call ETF. Now, this is essentially an ETF that holds high dividend stocks that will also pay you a massive dividend. I think right now it's around 7%. Maybe 6.75%, somewhere in that range. However, they just recently lowered their dividend by a penny, and a lot of people are asking, why is this the case? Why are they lowering? Is this bad news? Should we sell? Should we get out? Should we go to something else? Well, I'm saying, well, this is something that happens once in a while with covered call ETFs, because this is not going based off of earnings of those individual companies. What this is doing is going off of how much money that ETF can make off of selling covered calls. So there's actually a couple of different instances and a couple of different reasons why a covered call ETF could lower its dividend. And today we're going to really cover that. But first, how does a covered call make money? Well, a covered call, basically what they are doing is, let's say we have a company of stocks. Let's say we have thousands and thousands of shares of TD Bank. And let's say we have 10,000 shares. And we want to make money off of those shares while we hold them. Of course, we're getting a dividend, but we really want to make more money than what a dividend is. Well, we can sell a covered call, which means that we're selling a call option for 100 shares. And let's say TD is currently worth about $50 a share. This is just hypothetical, but let's say it's currently worth $50. Well, we can sell 100 shares or 100 covered calls, or essentially 100 shares in one call, and let's say our strike price is $60. So basically, let's say we sell one for a 6-month period. And basically what we are doing is we are selling to somebody who is essentially gambling the ability to pay us a premium of, let's say, $100 to be able to buy those shares in 6 months at $50 if they hit $60. However, if they do not hit $60, we keep those 100 shares and we keep that $100. And that $100 that we made, as an example, is now paid to us as a dividend. Now, obviously, ZWC has way more than 10,000 shares of TD, and of course, TD is not worth $50. However, this is just an example. However, how do we make money? That is the biggest question, and why would a covered call ever lower its dividend? Well, one idea, one option, or one thing that could happen is there's just not enough calls being sold. If the options market is drying up, let's say temporarily, then of course we're not selling as many covered calls, which then means that we can't bring in as much of the premium as we normally could. Number 2 is the fund is just not selling as many. And this could happen when the fund manager, as an example, may just say, well, we feel like the stock market's going to really accelerate in certain numbers of these stocks. Let's say the banks, for example, they really do accelerate, and we just don't want to sell as many of these covered calls because we don't want to be able to lose our underlying equity, which is, of course, the stock. And ZWC holds a lot of the Canadian banks, and we have recently seen a massive spike of the price of bank stocks. Now, they're starting to slightly come back down. However, this may be a sign that recently, over the last month or maybe even 2 months, that the bank managers noticed that this was happening, and they may have bought back a couple of their covered calls, or they may have just not sold as many, which would then mean that they are no longer going to be paying as high of a dividend because, of course, we're not making that premium off of those options. Now, the third option is a bit more scarier, which is, of course, we lost a lot of our stocks through options. And this may be a massive part of this as well. So basically what that means is if, let's say, that TD stock that we had met that price target of the $60, well, now we just lost those shares, however many that we had options for. And generally speaking, what I've been reading is most covered call ETFs will be able or will sell between 20 and 40% of their stocks through options. So this may have been a massive reason as to why ZWC lowered their dividend, because now we have lesser shares, so now that premium that we would normally be getting paid may be going back into buying more of those shares and getting them back. Now, this is when you would normally see the actual underlying value of that ETF would normally be coming down, which we do see right now. However, we also see the stock market going down as well, and it's actually going down roughly the same value as the stocks that it holds. So I actually don't think that third option is really the real option. So what do I think? What do I think is the reason behind the dividend getting lower? Why do I think? Okay, so what do I think it is? Well, let's go over these options. Less calls being sold. That is a very viable option. However, the options market is super hot right now, so I really don't think that will be the option. I don't think that is the issue, and because of that, and because of the fact that we've seen some very high volatility in the market, and the fact that a lot of the Canadian bank stocks that it holds have spiked in value, I personally think, because how these ETFs generally pay out their dividend is about a couple of months after they actually receive that money. Usually it's a month after, sometimes it's 2 months after. It depends on the ETF. This one, considering that it pays every month, I would really believe that it would be because of last month's options strategy, and that may be the fact that they may have sold less options because the price of the bank stocks were accelerating last month and of course the month prior. Or it could be the fact that we just lost those shares and now they're trying to buy them back to have that underlying equity back into the actual stock market. And now that we're seeing the stocks of TD and all of the other banks coming down and of the other stocks coming down, that may be the actual issue. So I think it's a cross between possibility number 2 and possibility number 3, where they just may not have sold as many options to protect the underlying asset. Or it could be the fact that now they're putting a little bit of that premium back into buying the shares so that they'll have them again. It could be both of those issues. It could be both of those situations. Personally, I think it's number 2, where we just the fund managers possibly could have just not sold as many options, and that's why the actual cost of the dividend is now lower. Of course, they don't tell us why this dividend did lower. However, at the same time, these are the possible options or the reasons why it did lower, and we'll have to see. We'll have to probably wait 3 or 4 months to see if they raise the dividend back up. If they continue to lower the dividend, that would then raise an issue, especially if the underlying issue of the stock goes lower. However, at the same time, I don't see that happening right now, so I don't think that's the issue. I hope that this video has kind of given you some information onto how covered call strategies work. If it has, hit that like button and subscribe, and I'll see you guys again next time.